Afternoon, everyone.
We'll be starting in a couple more minutes, just waiting for a few more people to join. I think everyone can hear us all right. Let us know if not.
We're just going to wait for everybody to join.
Yeah.
And then we'll start.
Awesome. Cool. Just a couple more minutes, or one more minute.
Yeah.
Give everyone an opportunity to jump on.
It's just put a slide on.
Awesome. Everyone should be able to see that. Okay. So I think we'll make a start. It's 12:30 now. So
Okay.
cool.
All right. Welcome, everyone. Good afternoon. So Jack and I are going to talk about what we think are the 5 key points when buying an industrial property. So that's 5 of our probably our most important points. We do have a lot of additional points that we check when we're buying a property, but these are the most important we consider. Just a quick note that Provincia is only for wholesale investors, and yeah, so we have to let you know because of the financial markets. So next slide. So Jack and I started Provincia 5 years ago now.
Yeah. 5 years.
And we started with 1 property out in Mangere, and now which has a value, or had a value at the time of just over 5 million, and we had 7 investors on that property. Today we have got 128 investors, and the fund is valued at just over 94 million. So we've had steady growth over the 5 years. We haven't rushed into it, and we always say that we're very fussy on the types of property that we put into the fund, and most importantly, we only look at properties that we can add value to in the short to medium term. So that means we can find something to increase the rent and therefore the value. So our overall aim is to create a diversified portfolio of value add property, and we only focus on industrial property. We're not going to branch out into office or childcare or any of those other sectors. We're convinced that industrial property has stood the test of time, and that it is by far the safest commercial investment in New Zealand. So as I said before, we focus on industrial value add. We look at areas where there's only sound economics, so where there's other industry and good population growth, and we focus on properties between 5 and 10 million. Main reason for that is because if we have a vacancy, properties valued at between 5 and 10 million are relatively easy to re-tenant. So if you start getting 20, 30, 40 million dollar properties, we may end up with a vacancy, and which means less cash flow for the fund. So that's our focus, and that's just a basic outline of our overall strategy. So I'll just hand you on to Jack.
Cool.
So Jack's going to talk about our 5 most important factors that we consider.
Yeah. So we've got a 37, as Carl touched on, we've got a 37-point checklist, which we go through whenever we're acquiring new property for the fund. So we look at a lot of properties prior to getting anything under contract. But if it meets our basic criteria in the first instance, we then try and get it under contract. Once we've got it under contract, subject to a due diligence period, that's when we start that 37-point checklist, really ticking off what we need to look at. So today we're going to talk about the 5 key factors, 5 of the major factors that we look at when we're looking at commercial property. So number 1, probably the most important to us, is the lease. So the lease agreement, when we're looking at commercial property or when we've got the property under contract, is probably the key thing. So we look at factors such as what is the term of the lease? Is the correct tenant on the lease, which is a major one, and what is the term? So is it a 2-year lease? Is it a 1-year lease? Or is it an 8-year lease? So how long does it have to run? And we look at properties that have different factors. So we might look at a property that might have a very short-term lease, and we view that very favorably, because what that gives us the opportunity to do is to negotiate or renegotiate that lease, depending on what the tenant's criteria is or what the tenant's position is based on the property. So that's a starting point for our due diligence and having that discussion with the tenant. We also want to look at what the upside is in the lease. So when is market reviews? Is there annual increases? So annual increases gives us the ability to slowly increase the income to the fund, or is there market reviews? So when are those market reviews? And what is the market rent? So is it under rented or over rented? So what we try and do with Provincia on any property that we try and buy is we try and add value either prior to the acquisition. So that might be by renegotiating the leases and having that value add from day one, or making sure that we've bought a property that has favorable lease terms for the future. So that might be an under rented property that we know is coming available in 2 to 3 years. So we've got one particular property in the fund right now, which is in Rosebank Road. So a recent acquisition, which we did at the beginning of this year. And that particular property within the lease had 2 years to run on one tenant and 3 years on the other. But why we bought that property is because when we analysed it during the due diligence, looking at the lease agreement, we knew that the market rent that the tenant was paying was substantially lower. The rent the tenant was paying substantially lower than the market rent. So we've got that built-in upside. So that's part of what we look for, is can we add the value up front by renegotiating that lease, or is there something locked away that we could unlock over time? Because that gives us the opportunity to increase the return to our investors and also increase the fund value, which we've done over time for the last 5 years.
And as Jack's saying, quite a bit of this value add can be added during due diligence. So it's relatively low risk. And it's a really good way to do when you're not 100% committed to the purchase of the property. So you can add a lot of value through altering the lease and doing a deal with the tenant.
And sale and leasebacks, which we touched on last session, that's another common way you can negotiate during the due diligence. So one such sale and leaseback, which we touched on last week, is the most recent acquisition, which we're doing in New Plymouth. And we've actually been managed to negotiate a 10-year triple net lease. So it's a 10-year lease. So ultimately adding value from day one, as Carl just touched on.
Yeah, and just on a triple net, that's probably Jack's done really well there, because the triple net lease is the ultimate lease you can get, because the tenant covers all expenses, including the majority of the landlord's responsibility as well. So over that 10-year period, what that means is that the tenant covers everything. So there's no capital expenditure from the landlord. So if you can get a triple net lease.
Yep. And the valuers view that very favorably as well. So the second, probably most important topic or item that we check off during our due diligence is the building area, or the building area survey. So what that means is we're looking at what is the actual boundary of the property that we're buying. So this is an example on Carbine Road, one of the properties that we have in the fund. So when you're buying the property, you want to make sure you know exactly the boundary and where the boundary is based on the title. So that's number one. So we analyze that first to make sure we understand exactly where our boundary goes to, and then look at the leases. So we've got the first point, which is the lease. What rentable areas are stated on the leases? So are there certain areas that haven't been rentalized that the tenants are using, or in addition to what the tenants are using? So what I'm saying is, can you find additional space within the building profile that could be rentalized to the tenant? Or is there certain spaces inside the warehouses, so such as mezzanine, or are the office measurements or warehouse measurements correct, which a valuer usually will laser measure, so we can answer that question. So that's the second most important topic that we look at, because what that enables us to do, such as on Carbine here, is there's that rear yard. You can see that rear yard in the middle of the photo, which that yard wasn't actually rentalized. So during the term when we were looking at the in the due diligence, looking at the property, we realized that yard wasn't being utilized by any of the tenants in their leases. So we knew that in the future, that particular tenant, which is in the back, in one of the rear warehouses there in the center, they had their lease coming up 1.5 years after we acquired the building. So obviously that they might renew it or they might walk away, and that gives us the opportunity to increase that rent, because we can actually therefore rentalize that yard area, and we can make that yard exclusive to their property. So that's some upside that we knew we had for the future on this particular property. And sure enough, 1.5 years came, this tenant, they were underutilizing the site, so they left, and we got a new tenant in, and we're able to hike the rent up substantially, because we're able to include that yard space, which rents for about additional $50 to $55 a square meter. So that's an additional $50 to $55 a square meter that we unlocked and passed on to the fund as rental, and then also creates and adds value, just simply by looking at what spaces you can actually rentalize and what aren't rentalized in the current leases. And you can also do that with mezzanines as well. So often there's consented mezzanines in warehouses, and often those aren't rentalized, and they should be rentalized at about $85 a square meter. So that's another common thing that we look for in our property.
So typically during due diligence, we'll get our surveyor and our valuer to accurately measure the land, and also the building, and also the different areas of the commercial building, so that the office, warehouse, and the canopy. And quite often it is wrong, and this is another great way to add value for relatively not much cost. So if you can find another 10 square meters or 20 square meters of warehouse, you put that at 200 a square meter, that's you're adding value straight away. It's easy. So that's something that we look for during due diligence as well.
Yeah, definitely. So number 3, so this is the third topic we look at, which is the IEP, so the initial earthquake procedure. And what that is it's a rating of MBS. MBS is new build standards. So basically the building is rated on a percentage of new build standards based on its earthquake percentage. So what we look for is anything above a B, so a B grade there. You'll see building grade B in the left-hand column. So that's your 67 to 79%. So the banks and insurance companies require the building you're buying to be a B grade property. So that's 67%. That's a requirement of their lending. So anything below that, we need to assess why it's below B. So you might have a C grade or a D grade. So 34% to 66 or 20 to 33. And then what you want to assess is the cost to bring it up to a B grade or greater. So we have a lot of examples where we come across properties that are maybe sub 67. So they might be 40%, which is a C grade building. We had one in particular in Arwen Place that was this is an example of that, and it was 40%. But often you can easily get the building up to a substantially good IEP, 67 or 80, simply by having a look what's actually in the buildings, because often the council IEPs or the initial IEPs are low, but they don't investigate what's actually inside some of the structures in the building.
So quite often the council rating on a building is based on a drive-by.
Yeah.
So, and that scares a lot of people off because that's what is listed on the LIM report in the council file. So what we do is we get a detailed engineering report from our expert engineer, who also happens to be an investor in the fund, which really comes in handy.
Yeah, so on Arwen, when we were investigating Arwen Place in East Tamaki, one of our properties we acquired, the MBS was only 40%, as I mentioned. And when we dug into it and found out why, it was because there was warehouse roller doors that had been cut into the building in the 90s. And when they cut those roller doors in, they actually cut out the cross bracing that was located behind those roller doors. So they moved out, cross bracing, which helps the building be structural. So that reduced the IEP to 40%. But it was easy enough to bring the building back up to nearly 100% simply by putting cross bracing on the other walls and some additional cross bracing in the roof. So the cost to do that was 40,000. So 40,000 on just over a 5 million acquisition. So the cost to bring up the building to a good IEP standard that acceptable by the banks was very low compared to it was very off-putting for a lot of other investors. So it gives us that opportunity to pick up a building that, might be considered not favorable by a lot of other investors. And we've got that advantage because we can work out, okay, what is it going to cost us and get it for a substantial discount because of that, even though usually it's not so bad for the cost to bring it up to MBS. Yeah,
so what Jack is saying is that buildings below 67% new building standard, often most investors are scared off because they have to get lending from a bank. So they immediately look at it and say, no, we can't get lending on that building. So we'll move on to the next one.
Yeah.
So what we do is we look at them and we say, how can we upgrade it to 67% or better? And then we do all the calculations and estimates on how to do that during due diligence. So again, there's no risk of committing to the building and having to spend a whole lot to bring it up to standard.
And so the fourth thing we look at is the LIM and council file. So the LIM is your land information memorandum and council file. So they're the two documents that we look at when conducting due diligence. So that's one of our fourth most important items. So the LIM, the land information memorandum, is a document that holds all the information that council has on the property. So what we look for in that is we look for the building consents. So we look for what notices have been issued against the property, what building consents there are, what resource consents there are, and what building consents have been signed off. So what you want to check for on the LIM is what building consents have actually been issued. So if the building consents have been issued, have they also been signed off? Because a lot of the time we see building consents issued on properties that actually haven't been signed off. So the CCC, Code of Compliance Certificate, hasn't been signed off based on that particular building consent. And that's something you want to look at, is why wasn't that building consent signed off? Sometimes the answer is the building consent was issued, but the work was never undertaken. So that's fine, but you want to make sure and check that in relation to the council file and in relation to the property itself. Or you want to find out if the building consent was issued, the work was done, but sometimes the work was never signed off. And you want to find out the reason why that work was never signed off, which is a very important aspect that we're always checking during our due diligence.
Yeah, so if Jack and I see a building that has outstanding CCCs, we see that as an opportunity as well. And that's something we can investigate during due diligence and get consultants, builders involved. Look at the council file in more detail, because quite often it's just something that's been missed, an inspection. There's also quite often you come across LIM reports that have abatements and warnings. So a lot of investors are scared off and they don't bother investigating them. And quite often there's an easy solution and a not very expensive solution.
Yeah. And then the council files have the documented resource consents and Code of Compliance certificates on them. So if you want to look at the detail behind what building consents are issued and what was involved in that building consent or the CCCs, that's all included in the council file, which is a separate document. and it has all the history based on that particular property as well. So we look into those as well as in relation to the LIP. So the fifth most important and one of a very important factor that we look at is the location. So whenever we're analyzing a property, we want to look at the location of the property in relation to vacancy in the area and other particular tenants or businesses in the surrounding area. So all of our properties are located in industrial areas. So we always look for industrial pockets that have low vacancy, and we try and assess the growth. So we look at how much in demand is the space, how many vacancies are there in the surrounding warehouses, is there a lot of vacancy or not much vacancy, and then how close is that location to transport, major motorway access, which is quite a big one, especially for logistics and operations in that particular area. So what we're trying to assess is what is the growth in that area based on based on the particular area we're looking at. So what the growth could be, and we're looking at factors such as the vacancy in the area, because that's something that we really want to assess in case a tenant is maybe wants to leave, maybe that's the end of renewal, or in case a tenant gets into trouble, how quickly can we change that tenant over based on the vacancy factor. So all our locations, we've got really good tenants, and we've proved that over the last 5 years, because we've had about 4 or 5 tenants change as a result from their leases ending or needed to upscale or downscale on back of COVID as well. But all of them, we've had 0% vacancy across the portfolio since we started. And that really signifies the due diligence that we're putting into the locations, and it shows the locations that we're buying have really high demand and really easy to get new tenants, as Carl touched on, given the size of the buildings that we're looking at in these locations.
And having buildings in a good location where there's low vacancy that ensures that we've had, so since the fund has started, we've had 100% occupancy. So Jack and his management team have done a very good job. He quite often gets himself into trouble though, because we have one tenant moving out and another tenant moving in on the same day. So
overlap.
Allow one day. So so since the fund started 5 years ago, we've had 100% occupancy. We haven't had a day where the building has been vacant.
Yeah. So there are 5 key points, but as we stated, there is another 32 of them. So 37-point checklist that we do go through when undertaking due diligence on any of our properties. So we've got a few frequently asked questions, which we'll just cover off. So question 1 is, how do I know if the tenants are secure? So that's a question we get quite a bit. And so what we look at is when we're doing the due diligence, we get basically a breakdown from the previous vendor or their ledgers. So we look at the previous rental ledgers to make sure that the tenants were paying on the, generally they pay monthly, maybe the first, second or third. So we make sure that's coming in regularly and there's nothing being delayed. And if there is, why was that particular payment delayed? So that's one aspect. The other aspect is looking for what kind of bank guarantees or personal guarantees or cash bond that there is on the lease. So that again relates to point 1, looking at the lease. Is there a bank guarantee? If so, how long? Is there personal guarantees from the directors? And if those personal guarantees are on the lease, what assets do they actually have in their own names? Because you want to check out, just because it's got a PG, you got to make sure that personal guarantee, there's assets behind that. And then also the cash bonds. So cash bonds are really good. And how long are those cash bonds for? Or what amount is the cash bond for? So that's how we look at how secure a tenant is, just to make sure we're covering that in case the tenants do get into trouble.
And a couple of other good checks is to look them up on the company's office, make sure that their company is in good shape, it's not in liquidation. Do a credit check on the personal guarantors, and also check out the industry that they're in. Get a good understanding of what their product is, what they make, and how they're placed in the market.
So question 2 is, what is gross yield and what is a good yield for an industrial property now? So gross yield is simply the rent you're getting divided by the purchase price. That's a good way to work out your gross yield as a comparison on different properties in the current market. And what's a good yield for industrial property now? I think especially in Auckland, there are properties that are selling for around the 4.75 to 5% still. So we're still getting properties sell below that 5% mark, even with interest rates as they are now increasing. But a good yield in this market, if you can get any property in the 5.5 to 6%, so it's slightly higher than what some properties are selling for, if you can get anything in that 5.5 to 6% range, you're doing pretty well, especially in Auckland industrial property in the current market. And question 3 is, how is industrial property demand in the current market? So we get that a lot. There is a huge demand for industrial property space in terms of a tenant. So as we stated, we've got a lot of tenants and they're very happy where they are, but we're also seeing a very record low vacancy rate in a lot of these industrial precincts, which shows there's a lot of demand for industrial property from occupiers, and that's especially on the back of COVID as well, especially from logistics and distribution companies that are looking for storage. So that's a trend that's happened since then, which is keeping demand high. And in terms of sales, there's a lot of owner occupiers. So a lot of those types of businesses might be owner occupiers that want space. So that's keeping demand high. And there's also some investors that are looking. The banks are making it harder, which is hindering demand for certain space because of the restrictions the banks are putting on investors and also the climbing interest rates, but we're still seeing a really good amount of demand for industrial space.
Yeah, so as Jack's saying, at the moment, industrial space, especially in Auckland, is, in terms of vacancy rate, they're at all-time lows. And one of the major reasons for this is the demand for the warehousing due to more online shopping. So and adding to that demand also is retailers operating basically factory or warehouse to the end user rather than going to the retail store. So because of that, there's a much more or bigger demand for space. So what businesses are doing, they're adopting a just-in-case principle in terms of storing goods instead of a just-in-time. And another reason for that is the supply chain issues that's happening around the world. So again, more storage space is needed, and this is putting pressure on demand for warehousing and industrial property in general.
Yeah. So now what we'll do, I'll just stop sharing this. So if anyone has any questions for us, feel free to type them in or unmute your mics and you can ask us direct. So feel free to shoot through any questions or ask.
Hey, Jack, Shah here.
Hi, Shah.
How are you
Good.
doing? Hey, what are you, in terms of prime areas? Are we still looking south and Penrose and all that? Is it?
Yes. Yep, absolutely. So some of the high demand areas that we're talking about in terms of location is definitely that southern corridor. So South Auckland, Wiri's got a really good low vacancy at the moment. East Tamaki, there is construction in East Tamaki, which might show why vacancy has gone up slightly, but in terms of demand, it's at an all-time low. It's just that new construction that Goodman's doing a lot of, and a few other companies there at the moment, which could be reflected in some reports, but it is a really low vacancy, East Tamaki still, and Penrose. So that whole southern corridor is really good.
And are you seeing what 4.5% there as well?
For about 4.75 to 5%, that's what things are transacting for at the moment. There was a recent sale two weeks ago in Arwen Place. So that's Arwen Place in East Tamaki. We've got a property in that street that just sold for 4.75%. So there's still a trend that cap rates have come back a little bit based on what people are buying for, but we're still seeing it around the 4.75 to 5. So if you can get anything above that 5% mark, 5.5, even 6%, then you're doing really good. good buying in this market.
Cool. Thanks.
Yeah, no problem. Is there any other questions for us? If anyone wants to type in or unmute and ask.
Hi, Jack.
Hey,
In terms of the vacancy rates, do you get those from a statistics source, or is it just kind of what you know from the real estate agents?
Yeah, so both. So we can get them from, there's a lot of them are published in the Colliers reports. So those East Tamaki ones are slightly higher in this market because it's taking into account the new construction that's come online. So it's just online under the Colliers reports that they do. So that's a really good source of getting the vacancy rates for certain areas. So we keep an eye on that. And then a lot of our data is also from other agencies as well. James Group just started doing their reports on the different their different precincts, such as Wirri, East Tamaki, Penrose. So that's been really good. And then also from the valuers as well. We've got multiple valuations. So we get that feedback from the valuers. So it's a whole database that we're building here, but a really good one for individuals to look at would be the new get on the James Group mail outs, because that's really good. And then also the Colliers reports, which are all available online on their website.
Cool. Another question. So if the interest rate's going to go up a little bit further in the next 6 months,
yep,
what impact do you think that's going to have on yields through next year?
Yeah, I think they will come back a bit. So, we're looking at 4.75 to 5. That might go to 5 to 5.25, maybe even 5 to 5.5%. So I do think there's a little bit of room to drop. It just depends how high these interest rates are going to go and how long for. That's going to be the big kicker, really. But the demand is still there. That's what's keeping the interest rates down. Well, the yields down at the moment is actually that demand for space. Because although interest rates are rising, which will definitely impact yields for commercial property, there is only a limited supply of land. So our industrial precincts, if you look at on the unitary plan, especially in Auckland, also you can look in Hamilton as well, there's only limited parcels of industrial land. And those limited parcels are already pretty well developed. There's not a lot of new stock coming to market. Drury's being developed, but that's still a little while off. So especially in Southern Corridor, that's what's really keeping that demand high, is the limited amount of space and availability for commercial property. So you've got that trade-off between rising interest rates, yet limited space for warehousing. So that's going to keep the demand down, I think, based on that space.
Thanks, Jack.
Yeah, no worries. Any other questions?
Yes, can you hear me?
Yep.
Can a foreign individual qualify as a wholesale investor?
Yeah, it depends on where the tax residency is. If you're living overseas and you're a New Zealand resident, you still have to qualify as wholesale. If your residency is offshore and you have no links to New Zealand through tax or residency, there's no requirement for wholesale to be a wholesale investor. Does that make sense?
Yes, thank you.
But every individual application is treated separately, and that's something that we cover off in the application process and onboarding the investors. Does that answer your question?
Yes, thank you.
Okay, thanks.
Thank you. Any other questions for us?
Okay, thank you everyone for attending.
Yeah.
And thank you for your questions. And we'll catch up next week. On Tuesday and Thursday, we'll have another subject. So we hope you can join us for that as well.
And if anyone has any questions for us offline that they wish to discuss, feel free to give myself or Carl a call. We're happy to have a chat offline, and if there's any interest in any items that we have, that'd be great. Thank you.
Okay, good afternoon. Bye.
Thanks a lot.